Picture this. You are looking at a towering, absolute titan of Wall Street. I mean, we are talking about a financial behemoth that managed billions upon billions of dollars, operated all across the globe, and had earned the absolute, unquestioning trust of the world's most elite, sophisticated investors. This was a company that seemed completely unstoppable. It looked like it was built on a foundation of solid stone. Until one day, that foundation literally vanished into thin air. Gone. Just like that. Welcome to this explainer. Listen, today we are unpacking a story that completely blew my mind when I really started looking into it. Because this is not just a story about money being lost. It is about an incredibly elaborate, meticulously crafted deception. It's the jaw-dropping story of how one of the most respected brokerages in the entire world was actually just a hollow shell. They were masking a rotting, toxic core of debt, and its brilliant architect managed to fool the absolute smartest minds in global finance for years.
Now, what is truly terrifying about this whole situation, the thing that really keeps you up at night, is the sheer speed of the destruction. 7. It took exactly 7 days. I really want you to think about that for a second. 7 days for a seemingly invincible global financial powerhouse to completely collapse into dust and declare bankruptcy. We're talking about an empire that took decades to build, completely wiped off the map in a single week. So how does a disaster of that sheer magnitude happen so fast? What in the world could possibly trigger an implosion that sudden and, honestly, that violent? We'll keep that mystery in the back of your mind as we rewind the tape, because the ending of this story is an absolute nightmare. But the beginning, well, the beginning looked like an absolute dream.
To truly understand the scale of the shockwave that hit the markets, you have to understand just how incredibly successful this company, Refco, appeared to be right up until the final seconds. Let's go to August 2004. An elite private equity firm called Thomas H. Lee Partners swoops in and purchases a majority interest in Refco in a massive leveraged buyout. Basically, they bought the company using a mountain of borrowed money. And the price tag for this? A staggering $1.9 billion. Fast forward just 1 year later, and they take this giant to the public markets with an initial public offering, or IPO. They let everyday people buy the stock, and they raise another $583 million. The stock gets listed right there on the New York Stock Exchange. You've got the executives up there ringing the bell, smiling for the cameras. Wall Street is cheering them on. Everything is perfect. Refco looks like the ultimate undeniable financial success story. The public, the investors, even the incredibly strict market regulators are completely, utterly clueless as to what is actually waiting for them in the dark.
Part 1. A wall of hidden debt.
Okay, so to figure out where the rot actually started, we have to rewind the clock all the way back to the 1990s. Back then, Refco was this thriving, privately held brokerage firm, and it was run by some seriously brilliant minds, including a guy named Phillip Bennett, who would eventually take over as the CEO. Now, their main gig was handling clearing services. Think of them as the vital middleman, making sure millions of market trades actually went through smoothly. They dealt heavily in derivatives, which, are just complex financial contracts based on the value of other assets. From the outside looking in, highly successful operation. Nothing to see here. But beneath that highly polished professional exterior, a silent catastrophe was already unfolding. The firm was quietly bleeding out. Customers who Refco had extended credit to were making bad trades and just failing to repay their massive loans. On top of that, Refco was suffering its own terrible trading losses. Over time, this combined bleeding escalated to hundreds of millions of dollars. Now, in high finance, if you admit to hundreds of millions in sudden losses, it's game over. Your credit dries up instantly, your clients panic, they pull their money, and your firm dies. The executives were staring at a lethal, impossible wall of debt. They basically had a choice: confess and lose everything, or find a very deep, very dark hole to hide the bodies. So what do you do? How exactly do you hide hundreds of millions of dollars from the smartest financial watchdogs on Earth? This right here is where the deception takes root. Phillip Bennett decided he was absolutely not going to let Refco fail on his watch. He needed those toxic, business-killing losses completely off of Refco's official books. So he made a move. He directed that all of this debt be quietly transferred to another entity called RGHI. That stands for Refco Group Holdings, Inc. But here is the critical, crazy piece of the puzzle. RGHI was a holding company that was completely owned and controlled by Phillip Bennett himself. Yeah. By moving the massive debts over to RGHI, Refco suddenly looked perfectly clean on paper. Instead of showing huge, terrifying trading losses, Refco's books simply showed that RGHI owed them a massive, perfectly healthy pile of money as a receivable. It was a neat little trick, at least for a while.
Part 2. The quarter-end magic trick.
So Bennett has this massive hidden debt, right? But here was his terrifying problem. At the end of every single quarter, these incredibly strict external auditors would come knocking on the door to demand the books. And if those auditors saw that Refco was owed hundreds of millions of dollars by its own CEO's personal holding company, they would instantly smell a massive conflict of interest. Red flags everywhere, and the gig is totally up. So to get around this, Bennett built a highly illegal, wildly complex financial loop. Let's actually walk through it step by step, because it's nuts. Step 1. Right before the quarter ended, an offshore Refco subsidiary would make a massive, short-term loan to a friendly third party. We're talking hedge funds, or even a bank like the Austrian bank BAWAG. Okay, step 2. That third party would immediately turn around and loan that exact same amount of money right to RGHI, Bennett's private company. Step 3. RGHI takes that fresh money and finally pays off its massive secret debt to Refco. Suddenly, Refco's books look completely crystal clear. The toxic debt to the CEO is magically gone, replaced by a totally normal-looking loan to an unrelated third party. The auditors look it over, give a thumbs up, and leave. But then comes step 4. Literally just days after the fiscal period ends, the entire transaction is unwound, reversed. The money flows backward, and that massive secret debt is dumped right back onto RGHI, hidden safely in the shadows until the auditors come back the next quarter.
The staggering difference here between the fantasy that they sold to the public and the reality they actually lived in is just mind-blowing. To the outside world, to the press, to the auditors, Refco reported total, pristine financial health. They claimed they had plenty of excess working capital. Everything is great. But the actual reality? They were so utterly starved for cash behind the scenes that they couldn't even meet the daily obligations for their customers. The entire empire, this multi-billion-dollar giant, was being propped up by phantom loans and smoke and mirrors. Just think about how wild that is for a second. If you or I lied like this on a simple mortgage application for a house, we'd go straight to jail. But here, a massive Wall Street corporation was doing it to the tune of hundreds of millions of dollars over and over again, and the financial watchdogs saw absolutely nothing.
Part 3. Faking the financials. Now, simply hiding a mountain of bad debt wasn't enough for Phillip Bennett. The guy had much bigger dreams. He desperately wanted that massive $1.9 billion buyout we talked about, and he wanted to take the company public. But to attract those elite, high-level buyers, Refco couldn't just look stable, it had to look incredibly, almost unnaturally profitable. The desperation here is palpable. It's crazy. He actually went from just hiding bad news to entirely faking good news. In one instance, around early 2005, Refco had a shortfall in their projected earnings. Bennett's solution? He just arbitrarily increased the interest income that was supposedly owed to Refco by his own company by exactly $12 million. Poof, just like that. Fake revenue generated completely out of thin air. In another instance, he ordered 32 completely fictitious foreign exchange trades between his company and Refco. Literally faked them. They basically pretended to buy foreign currencies at the highest price of the day and sell at the lowest, deliberately turning a $5 million loss for his side into a $5 million fake gain for Refco. It was pure, unadulterated financial fiction.
Part 4. The House of Cards falls.
The craziest part is, for a brief moment, the illusion actually worked perfectly. The buyout went through. Banks poured in $800 million in syndicated loans, meaning huge groups of banks pooling their money together to get a piece of the action, and Refco officially goes public. The IPO is a massive, roaring hit. Phillip Bennett personally pockets reports of somewhere around $100 million in cash. The man is a billionaire on paper. But listen, a house of cards this massive, built on this much deceit, could only stand for so long before the wind blows. Remember those 7 days we talked about at the very beginning of this explainer? Here is the brutal, unforgiving timeline. On October 10, 2005, the music violently stops. Refco is forced to publicly admit they just discovered a $430 million debt owed by their own CEO. The market gasps. Just 2 days later, Bennett is formally arrested for securities fraud. The very next day, October 13th, the panic is so absolutely severe that the New York Stock Exchange steps in and halts trading on the stock entirely. And by October 17th, exactly 1 week after the initial discovery, this multi-billion-dollar titan formally files for bankruptcy. 7 days to completely self-destruct.
The sheer destruction of wealth that followed was absolutely breathtaking. I mean, just weeks prior to this unraveling, Refco stock was flying high, trading at $28 a share. Everyday investors thought they were holding pure gold. But when that illusion finally shattered, the stock price nosedived straight into the abyss. It plummeted from $28 all the way down to just 8 cents a share before it was inevitably delisted. 8 cents. In the absolute blink of an eye, the life savings, the college funds, the retirement accounts tied up in Refco's public stock were completely, utterly obliterated. No warning, just gone.
Part 5. The brutal aftermath.
You know, a scheme of this immense, staggering complexity, one that spanned nearly a decade involving offshore entities, massive hedge funds, and dozens of fake currency trades, It doesn't just happen by accident in a vacuum. It requires enablers, people turning a blind eye. And this right here, this is the document that finally brought the hammer down, the official SEC complaint against Phillip Bennett. This is where the federal government meticulously laid out the dark mechanics of a disclosure fraud that ultimately led to Refco's total demise. And as investigators kept digging, they eventually uncovered that at its absolute peak, the hidden debt had actually grown to over $1 billion. And the total fraud? It amounted to a mind-bending $2.4 billion.
Now, what is really interesting about this slide is looking at the specific legal language the SEC used. If you look under the section titled Concealment of Related Party Transactions, the government details exactly how those toxic trading losses from the mid-1990s were intentionally shuffled off Refco's books and dumped into Bennett's private entity. It outlines how the so-called receivables came to include not just the massive trading losses, but even Refco's own operating expenses and completely fake accumulated interest. This document is literally the autopsy report of a deeply, fundamentally compromised company. It lays bare exactly how they pulled the wool over everyone's eyes.
As you can imagine, the toll of this collapse was incredibly heavy. Phillip Bennett, this highly respected, Cambridge-educated financial mastermind, was sentenced to 16 years in federal prison. Shareholders lost hundreds of millions of dollars that just vanished into the ether, never to be seen again. But honestly, perhaps the most shocking, unsettling revelation of the entire federal investigation was the indictment of Joseph Collins. Collins wasn't just some low-level accountant or rogue employee. He was a senior partner at the highly prestigious law firm Mayer Brown. He served as Refco's longtime outside counsel. The government charged that Collins actively helped draft the very loan documents that temporarily transferred the massive losses off the books every quarter. He didn't just fail to catch the fraud. Prosecutors alleged he intentionally furthered it by telling deceptive half-truths to the buyers and the big banks. The very guy supposed to ensure everything was legal was writing the script for the lie.
Which brings us right here to this absolutely chilling quote from the U.S. attorney at the time, Michael J. Garcia, regarding the indictment of the company's lawyer. He said, Collins' role in the fraud was vital because the people he lied to believed him as a result of his long-standing relationship with the company and his stature. And man, it just leaves us with a profound and deeply unsettling question, doesn't it? When the numbers are manipulated, we look to the auditors to save us. When the rules are bent, we look to the lawyers for protection. But when the highly respected, elite gatekeepers of our financial system are the very ones actively drafting the documents to hide the truth, how can we ever truly know that the ground we are standing on isn't just an illusion? Think about that the next time you look at a supposedly perfect corporate balance sheet. Thank you for joining me for this explainer, and keep your eyes open out there.